Without further ado, I am going to introduce my bestie over here. He gets the most voluntold award in SARE for the last couple of years, and my also my neighbor Tony Hoong, the CPA did. Thank you,
All
thank you
right.
for coming.
Sweet. Thanks, Annie. Appreciate it. Thanks everyone for joining tonight, spending your evening learning about taxes. And yeah, the presentation, there's not one to say. I'm actually going to try something new. So we always go through slides and everything, but I'm going to like tailor it a bit more just to understand the crowd here. So if you don't know who I am, Tony Hoong, I own a tax planning firm. Also file taxes too. It's called a CPA Dude, and primarily just find ways to help you not pay the government. And yeah, so tonight, if you guys want to just let us know in the chat if you're W-2, you're a small business owner, real estate investor, and then that way we can tailor the presentation or my stick figures and chicken scratch towards that. And then that way it can be a bit more tailored towards that side. But I got primarily a W-2 stick figure presentation ready to draw out if no one drops anything in the chat there. But yeah, that's primarily a lot, folks. So cool. W-2, small business owner. Well, yeah, just because the tax strategies, the reason why I ask is the tax strategies are quite different depending on if you're W-2 versus small business owner versus like a real estate investor or if you have a couple of them. So yeah, whoever responds, we're just going to give you free tax advice for whatever your situation is. And then yeah, at the same time too, just want to bring as much value as you guys can want. So happy to give away all the free advice that I can during this hour or 49 more minutes that we got going. So cool. We got W-2, W-2 plus real estate investor, 1099, W-2 real estate investor. Oh, reps. We got one reps in here. W-2 small biz, some real estate. All right, nice. And then W-2 1099. Okay. So we got a few in here. I got one unicorn. Sarah's already a rep, so solid work there. So cool. I'll share my screen on on my iPad. So I'm going to draw this thing out on the iPad. The one thing I noticed and the reason why I'm changing up the presentation is when I speak taxes, it just glosses over everyone's head. So I'm going to try the drawing method now and showing the parts versus just speaking about it. So I'm share screen. I hope this works. Start broadcast. I know how it works on Google, but I don't know about Zoom, so I hope this works. Um, yes, I think it works. Okay, cool. All right, perfect. Okay, I think this works, and I'm going to start drawing, and I'll go from here. And then if you can't read anything, my apologies for my terrible handwriting. All right, so right here, so let's just start at the W-2, folks. It looks like that's like the biggest part across the angle here is the W-2 strategies here. So W-2 strategies, it's not good. I'll just cut it to you straight right now. So the big part is that W-2, the tax code's not written for W-2 folks. However, there are small things that you can do, and we'll just pick away the small hanging fruit that you can take now and also how you can elevate your game. And that way you'll start saving some money on taxes, and then you'll eventually snowball that into a larger portion. And then the overall thing here too is like if you don't have a tax plan, you definitely want to craft up some plan. And it doesn't have to be super elaborate. Just like a workout plan doesn't have to be crazy. It can just be like, dude, go walk 60 minutes a day. Your tax plan can literally be that simple, or it can be like super detailed. So in terms of the W-2 strategies, we'll just hop right into it. Some of this may be super basic 101, but I have learned that a lot of people do not take advantage of them. So just the first one is just going to be your 401k. And this year it's going to be 23.5k that you can put in as the employee. And then the employer match, this one's always been like debatable and on if you should put in enough to grab your employer match. And generally speaking, I would say it's probably a good idea. It's free money on that side to just grab it right away. The one part about 401ks though is that if you're heavily like, I hate my W-2, I need to quit my job ASAP, you may not want to do the 401k, right? It may not be a great idea. So it's really dependent on you. And then the other part too on 401ks is some people just get too brainwashed by the 401k and they have too much money into it after a certain point. So say if your 401k is going to be, just to say you're 30 years old, and I have no idea what the average age everyone here is. I'm not 30, I wish I was again, but you're 30 years old, and say you have about 500k in this thing already because you've been saving over the years. So the average principle is that every 7 years, your money 2x's. So that means in 7 years, when you're 37, this is going to be 1 mil, right? And then that 1 mil, when you're 44, again, it's going to be two. So the reason why I bring this principle up, and not a financial advisor by any means, that is definitely our friends that might as well was, is that you don't need that much money into it, and it may not be good because then you're shortchanging yourself 23 grand each year that you can use to buy real estate. So it's not a, also I do want to say that it's never a war on securities versus real estate versus business. It's not a or item, it's always an and. So, just think about your 401k, check out how much money you have into it. Like, do you actually need that much more into it? You could stop. So that's your first piece of low-hanging fruit that you can have. Your second one is just going to be your IRAs, right? And IRAs is there's so many flavors of the IRAs, and those flavors, just for your education here tonight, is you have your traditional flavor, you got your Roth flavor, you got your self-directed flavor, and then within the self-directed, you also can have two more flavors. This is like Baskin Robbins. You can have all the flavors you want tonight. So you have your traditional again, or you can have your Roth flavor again. So many parts on the IRAs you can also put towards your IRA. Once again, just like your retirement account, if you have enough already, you may not need it. So traditional IRA, it's great. You can contribute towards it no matter what. Roth IRAs, if you make too much money, so if you're rich, you might have to do the backdoor Roth IRA. So just be aware about that. I think rich this year is somewhere around 150-ish. It keeps on adjusting for inflation. I never remember. But your Roth IRAs is great. But the biggest one for real estate investors here is your self-directed IRA. And a self-directed IRA is, generally speaking, is your IRAs. They only allow for stocks, generally speaking. And the conspiracy theory that I have is that they want to keep it in stocks so they can make more fees on the stocks itself. And self-directed, though, this allows you to have more than stocks. You can have stocks, you can have gold, you can have crypto, and surprise, surprise, you can have real estate, right? So your real estate is a great way to invest towards a self-directed IRA. It's a great way to unlock money. So say if you've been running on the hamster wheel forever and you're like, all right, peace out, I'm not going to do this no more. You can roll over your 401k. So all the way here, I wonder if I can draw all the way down. You can roll your 401k all the way down to your self-directed IRA, right? So then you can start investing in real estate. And once again, traditional versus Roth. And some people get confused on what's the difference between a traditional IRA, Roth IRA. So when you hear the words traditional, this just more or less means pre-tax, and then this is post-tax. So what that simply means is that traditional IRAs is that, the money grows tax-free, but then when you take it out, you pay taxes. And then Roth just simply means that you put the money in, grows tax-free, and then when you take it out, it's tax-free. And then the question that I get all the time on is, should I do traditional or should I do Roth IRA? And it really comes down to two things. It's one, how rich will you be when you're 59.5? Second part is, what's your views on the government when you are 59.5, right? AKA, do you think tax rates will go up or down, right? So the reason why you have to evaluate these two items is that if you think you're going to make more money when you're 59 and a half, then Roth probably is a better idea for you. If you think you're going to make less, traditional may be a better idea for you. And then same thing with your viewpoints. If you think tax rates are going to go up, Roth is more likely a better idea. If you think they're going to go down, traditional could be a better part. So it's just your own bet. It's hard to have a crystal ball on that side, but those are the two different flavors. And the self-directed IRA it's great for real estate, but I see some people get confused about the self-directed IRA. The self-directed IRA, these are my personal opinions, is that it's really good for syndications and flips, right? So anything, and the reason why is because these have massive upside. At least you hope that your syndication is going to do well, your flips are going to do well, and that way all the gain is tax free. So you can just keep on reinvesting that money all tax free. And the reason why I don't like it for, say, if you're a reps or you are like the short-term rental loophole, or if you are, yeah, those are long-term rentals. Anything where you're buying and hold, essentially, buy and hold, it's not so good. The reason why I don't like it is because depreciation, you don't get it. Like you lose it because a self-directed IRA is an account that says, hey, I'm not gonna like tax you on any gains, but at the same time, you also don't get any losses. So that's when to use a self-directed IRA. It's kind of really up to you. But hey, if your funds are limited and everything in your whole life savings is in your 401k, you might just have to bite the bullet and take that first step. So that's in terms of IRAs, W-2 strategies. The next part, the low-hanging fruit stuff still, before we go into the more like advanced intermediate stuff, would just be, take care of your HSAs, your FSAs, like any pre-tax benefits you can get are going to be good. So your HSA just stands for your health savings account. So it's your health savings account. And I can't remember, it's somewhere in the 4,000s right now of like how much you can put in. This is probably the best account that you can have though, because it's triple tax advantage, goes in, you contribute towards it, you get a deduction. You grow it tax-free, tax-free. And then lastly is when you take it out for medical expenses, it is tax-free. So this is the only account in the whole US system where it's triple tax advantage. Like IRAs, 401ks, they're double tax advantage, but HSAs are triple tax advantage. That's why you can't put a lot towards it. One like pro tip on using your HSA is that you put money into it. It can keep on going into and grow. And then the big part is it'll grow. Say you just choose like the S&P 500 and then let it compound forever, right? Like when I'm saying forever, you can let this thing compound for 20 years, right? And then this becomes $1 million account over 20 years. And then you can technically save all your receipts for all your medical expenses and then reimburse yourself just all in that 1 year if you want. So that's how you can get money out of your HSA all like tax free and compounded. So you could use it every year, but you're losing the opportunity for it to grow. Like that's where the big magic is on the growth. So it's just one tip that I don't see a lot. And most people just use the HSA within the current year and they're going to lose out on the tax-free savings. So just one part on how to use your HSA. And then your FSA, you may not need this. This is generally for families that, hey, have like childcare on this part. So childcare, and then at the same time to like fixed expenses for medical. So it's not too bad of a benefit, but it is a use it or lose it part. So that's your FSA. So those are some low hanging fruit items that you can do. Now tapping into like the best and the biggest splash here is going to be is your short-term rental loophole for W-2 people. So the short-term rental loophole, this is by far the best strategy, I would say, for real estate plus tax benefits. But however, it's like do invest for the property itself. Don't invest just for tax benefits. So the big part on short-term rental loophole is just to use this to reduce your W-2 income. Now, to like rewind a bit back, is that when you buy real estate, you buy any type of real estate, it's defaulted as passive. So This is all passive, long-term rental, short-term rental, mid-term rental until you turn it into active. And how you can turn it into active is by using the short-term rental loophole. What that simply is that you do, a couple of hoops you have to hop over. You just have an average stay of 7 days or less. And this simply means that your total days divided by your total stays is 7.0 or less. So some people they think that they can only rent it out for like 7 days when I tell them this, and it's like, nope, it's not the case. Is this as long as you have enough days or stays that's 7.0 or less, then it's good to go. So your days, let's just say you had one 30-day stay. So you have one, oops, yeah, one at a 30-day, and then you have like, I don't know, say 22-day stays, 2 days. See what do math here. So you got 40, you got 70 days, and then you have 21 stays. So that's definitely what, somewhere in the 3 point something. So way less than seven. So you meet hoop number one. So that's going to be your first hoop. And then the second hoop, and this is where most people get caught up on, is that you just need to show material participation. And there's 7 different prongs for material participation you can do, 7 prongs. But the 3 easiest ones that you can meet is one is just 100 hours and no one else works more than you, right? So the big part on this one is just what most of our clients use is the 100 hours, no one else works more than them, is you do want to make sure that the receipts documented by your contractors, your cleaners, anyone shows the amount of hours because the burden of proof is on you. And then you also need to track all your hours working on it. And the hours have to be like actually working on it. It can't be your investor hours. Like, yeah, it's you're actually doing the work, talking to your guests, coordinating cleaners, going to clean yourself. So operational work. The second one is 500 hours, and anyone else can work just more than you. But 500 hours on one property, it's not realistic. Like a full-time job's 20, 80 hours. That means a part-time job's 10, 40 hours. So like this is like a part-time job. And for the amount of money it makes, I don't think it's going to be worth your time to do 520 hours, 500 hours on it. So it's doable, but it's very hard. And the third one is pretty aggressive and it's legal, is that you substantially performed all services, aka you did all the work. So there's not an hour requirement on this one, but you do, the burden of proof is on you again to show that you substantially did everything. So documentation is going to be key. And the last part is you'll run a cost seg study, and we'll get into that later here on this. And like, why do all this? Like, this sounds miserable. It's a ton of work. Like, why are you going to do that? Is because, like I said earlier, real estate is all passive. If it's passive, that means it won't offset your W-2 active income. So going back here, like you have active and you have passive. I always say like these are like water and oil. The two just don't mix, right? So now you hop through all of it. Now your real estate is active. Your W-2 is still active. Now you can actually go ahead and you don't have this little line in the sand anymore. And the two can offset each other. And you're creating a massive loss through this by using a cost segregation study paired with bonus depreciation, accelerated depreciation, and also really good news. We're almost towards the finish line of 100% coming back. So they're really shooting for to get this done before Memorial Day, which would be massive. So right now, bonus depreciation is only at 40% this year. So if it goes up, like it's time to get back into the game. Like before it was like, I kind of just told some of our clients like, you can invest into it, but their tax benefit's not gonna be as good. If it goes back to 100%, you definitely want to stay shopping for sure. So 100% bonus depreciation, I'd say probably just wait another couple weeks and knock on wood, fingers crossed that it's going to work for everyone here. So that's the short-term rental loophole. You're able to finally take those active losses that offset active income. And then the other part too, I see a lot of mistakes on when the actual tactical part of doing the tax return is Schedule E versus C. And 9 times out of 10, the answer is E, right? C means you need a different CPA. Like whoever filed that thing's completely wrong. The only time that you need a C is if you're actually providing real services, right? Real services. And what I mean by real services is that you're a host cooking for them, you're taking them out, like you're actually running it like a bed and breakfast. And that's actually where the short-term rental loophole came out of the 1986 tax code. Is it was made for bed and breakfasts that were like operating as a real business, but able to take the real estate depreciation offset the ad income. So Schedule E versus Schedule C, but short-term rental loophole, like literally, you can generate so much. So if I take an example here, is you buy a $1 million home and let's just pretend you get 20% of this. Obviously, you have to run the cost seg to get the real numbers. Don't buy in states where land value is so high. But let's just say this equates to 200K in extra bonus depreciation. And then say you spent 50K for startup cost, you have a $250,000 loss right here, right? And then if you have, say, your income's $300,000, your taxable income's only be 50K. Or if you're, I mean, oops, lost that screen. Okay. Or, if your income is, let's say less than that, say your income's 200K, 250K part loss here, you'll pick up a 50K loss, and then this will actually go into your 2020, so it's 2025 right now, so your 2026 as a carry forward loss. So that would be huge for you there. So the short-term rental loophole, it's amazing for tax benefits and a great way to save money. And then the other parts too is just, the real benefit, right? Is it's like wealth, right? You're building wealth, passive income on this side. So this means you have appreciation and passive income. And then just the cherry on top is just the tax, right? So I always say don't invest for the tax benefits. It's just a nice way to see it. Because year two, so the downside, this sounds like sunshines and rainbows and everything, right? Unicorns, like everyone's happy. Now, the not so fun stuff of the short-term rental loophole is like year two. I always joke and say like it's like drugs. Like first one's free, it's great, but then you gotta keep on, you're hooked and you have to keep on going on it. Year two, you're probably gonna have positive income. And that means that you need to buy another property, right? So just like drugs, gotta keep it going. So that's gonna be the big part on the short-term rental loopholes. Year two, that's gonna be part. And then the other one that we get all the time is like, oh, what if I sell it? Depreciation recapture. Yes, that's a real thing to consider. Depreciation recapture. You're gonna have a massive cap gain, but that's when you want to consider other tax strategies to defer it, right? The biggest one being your 1031 exchange. So, yes, when you do sell in the future, you will have a big capital gain, but that's when you can start planning with a, tax advisor, ChatGPT, whatever you want, just don't pay the government. So, that's going to be the W2 side of items there. And yeah, I'll just take a quick pause. I'll just check out anything else in the chat, and then we can move on to 1099s, I think was the other part of the gang here. So we got cool. All right, Connie's getting game on the HSA. Nice. We'll shit the $500 and whatever your risk tolerance is. I always talk to my clients. I'm like, yo, you like to go to church or you like to go to Vegas? Like, where are you on like the audit spectrum? And pick your poison is what I say. So it's whatever you're feeling, how risky and frisky, my man. All right. And then we got run the risk again. Nice. Some good it's actually pretty funny. I was talking to my wife about like content, And like the comments are actually like so legit and the content out there is like the content is good, but the comments are sometimes like just as good as the content, if not better. But I digress. Maggie, oh hey Maggie, how you doing? How do you make the 250 cost seg offset to active income? Oh yeah, so this up here, that 250K offset, this $200,000 of expenses we picked up here, this goes back to cost segregation, which I forgot to explain. So let me go do that. So great question here. So cost segregation, what is it? Why do you need it? It's a super expensive study to tell you how much more depreciation you can get from your house. So by default, if you have a single family home, it's the IRS says the whole thing is 27 and a half years. So this is saying your floors, your doors, your windows, your cabinets. The IRS thinks it's going to last 27 and a half years. But we all know as landlords, these might last 1 year under a bad lease. So that's not true, right? But also on an STR, right? It's going to be considered vacation. It's going to be 39 years. So now all this is now going to be depreciated over 39 years. Now, the reason why you need a cost segregation study is because the IRS has defaulted the whole entire house to 27 and a half years or 39 years, but bonus depreciation only applies to useful life property of 20 years or less. So by definition, like you're screwed already up here because this does not meet it. So you need a cost seg study to break out the whole house into 5, 7, 15, 27.5, or 39 years, right? So how I like set it up here for you is, just say you have $1 million home. Let's see here, 1 million. And then generally the whole thing would have to be divided by 27.5 or 39. Super slow, but now you just take the million and they're just going to say, hey, this is 150K of 5-year property. This is, 25K. And then this is going to be 75K. So all this adds up to 250, if I can do math. Yep, 250K. Sometimes writing these examples live, I'm not that good at, but we make it work. So you can take 250K now up front versus before you could only take 1 million over 27 and a half years. Super slow. So you need a cost seg study done in order to break it out into 5-year, 7-year, 15-year properties. So that's the biggest reason why you need a cost seg study. The other thing too is from a cost seg study is that not all cost seg studies are the same. So they vary. So there's a variety of these. There's some ones that I've seen some for like 500, seen some at a grand, seen some at 2K, 4K, 5K, it's endless, right? So, and the biggest part though is that don't take it for face value. The issue is that some of these down here are computer generated. Some of these over here are more human generated. Let's see, here's human generated. And just a quick story here is that we had one client that we ran a study on. It was like a 1K quote, and then the other one was a 3K quote actually. And you would be like, well, no shit, I'm going to take the 1K, I'm going to save 2K right away. Like anyone would say that, but there's actually way more things below the surface that they didn't take into account. So what we did was we took total depreciation. I'm going to start a new screen here. So we got cheap, we got expensive. So you took depreciation times tax rate on both of these. And what happens is that that equals to tax savings. And what happened was the expensive one actually found more depreciation than the cheap ones. So sometimes, generally speaking, I think 8 times out of 10, you get what you pay for. And that one even though it costed 2K, it found so much more in tax savings that we pulled the trigger on the expensive one. So don't always take all cost segs of like, oh, hey, how much is your cost seg vendor? Oh, it's like a grand. All right, sign me up. Or, hey, I found this one for 500 bucks. Let me just take that one. The devil's in the details. So do evaluate it and like know how to read a cost seg report. Otherwise, you can be leaving some money on the table. So that's the big thing on cost seg studies. And then we actually have a partner now that we're white labeling them in house. So they're able to provide like audit defense at a good rate, at a wholesale rate for us. So it's been like a nice addition to our firm. But the other part on cost seg studies is see who your vendor is. There is a lot of AI cost seg companies I see popping up left and right. And I got sent a couple quotes from them and they were pretty shit for lack of better words. Like I was like, dude, this thing's gonna blow up under audit. So you're gonna pay an AI thing 500 bucks, 600 bucks, and you're gonna get a cost seg report. But then once you furnish that to the IRS auditor, you're probably gonna get blown up under it. So just evaluate once again, like I said, you want to go to church, you want to go to Vegas, pick your poison. How dicey do you want to get? How much do you want to save? Just having the audit protection is kind of a nice peace of mind item. So yeah, hopefully that helps Maggie in terms of answering your question of like, hey, where did you get the 250K? It's actually from a cost segregation study. And the beauty of this was from a real estate perspective on $1 million home, I mean, you can have many different down payments, right? You can have 3.5, your VA loan, you can have zero, you get a second home at 10, or you do the traditional 20%. And this is really how you arbitrage the tax differences here. So if you had 10%, that's 100K. And then you got a 200K benefit though, right? Sorry, 250K benefit that we're talking about, or 200K benefit, right? So you're really arbitraging it. So you're just robbing Peter to pay Paul. That's really how taxes go is like you rob Peter to pay Paul until you die, and then your heirs get it all tax free. Like that's really how it goes. Is you just keep on kicking the can down the road until you die, and then you get the step up in basis. So that's really where the short-term rental loophole, why real estate's so amazing, is that you don't have to spend $1 million to get $1 million deduction. You could spend $100,000, get $200,000 deduction. There's nothing else in the tax code that lets you do that. So that's why real estate's so powerful and why we're into it. But the big part is like don't let the tax tail wag the dog. Like buy the real estate because it returns what you want it to return, and it's not just for the tax benefits. So yeah, that'll be good there. Then yeah, let me just check some other questions here. What to do when I'm out of capital to buy more STRs? I think got to make some more capital or go raise some more capital is going to be that part for you, Jay. So time to get more into the creative financing part. I ran across these group of realtors in San Diego, and they were just picking up sub two deals like left and right. And I was like, dude, this is great for tax benefits. You're like barely buying it for anything or getting into the deal, but then we're able to take depreciation on the full. So that's been great. So out of capital, and I'm sure there's probably some rich people. There's a lot of rich people in this group. So, make some friends for sure. Dan, let's see here. Explain depreciation recapture. So yeah, depreciation recapture is essentially a way for the government to make sure they get their money back. So they're kind of like giving you out a loan. And depreciation recapture, let's just take an easy example here. $1 million home. In our example, you took 200K of depreciation. Your tax basis, and this is a big thing that most people get confused on, is 800K. But in your mind, in your world, you're like, my book basis, tax versus book difference basis here is 1 million. Because you're like in your head, you're like, I paid $1 million for this property. If I sell it for 1.1, I have a 100K cap gain. But in taxes, Uncle Sam likes to make it not so fun. I call him Uncle Scam, so that's his nickname there. But in the tax world, if you sell for 1.1, your basis is 800. So you actually have a $300,000. Geez, the iPad's doing math for us now. You actually have a $300,000 capital gain. And you're like, wait, what? And then this is broken down into a couple components. 200K was the benefit you took already, and 100K is a profit. So depreciation recapture just applies to the amount of depreciation you took already. Now the benefit though is this is capped at 25%. So it won't go past 25%. And then this is just normally taxed at your long-term capital gains or short-term capital gains, depending on how fast you sold the property. Generally speaking, most people are long-term capital gains. This is anywhere from 15 to 23.8%. So that'll be good for you. So depreciation recapture simply means that you're paying back the tax benefit that you took. However, if you get really granular with this, is let's just pretend like, let's see here. Dan, I'm going to assume you're rich as hell, my friend, and you're at the 37% bracket at the federal level. And you're a smart guy and you're listening to everything we're saying. Usually no one listens to me. And you did the short-term rental loophole at 37%. So you're going to get, so it's 2025 today. You're going to get your reduction, so $200,000 at 37%, right? However, when you go sell this bad boy in 2027, you're going to pay back the 200 at 25%. So you're actually arbitraging 12% of a difference and getting a benefit. So this is how you can really like get super granular into it. And if you have a high income year, like for example, your company IPOs or you get a fat ass bonus, it might be the year to do this because you're really arbitraging the difference here. So these are just like really small details. Like I always say, I always wish I could draw more. Like maybe this is like a devil. Yeah, I'm not sure. But the devil's in the details, right? My lack of drawing. So that's why I'm a CPA, for God's sakes. I'm not an artist. So, but yeah, hopefully that helps Dan. If not, just let us know. Nice. You wish? Not okay. One day you're gonna get there, man. Yeah. If not, you're just being humble. Don't want to let the whole world know that you're filthy rich. So great. All right, Anne, how are you doing here? All right, second year, can you switch to property management and just take regular depreciation only? Yeah, so on the short-term rental loophole, this is short rental loophole. Yeah, year one, you're going to work hard, right? Hard work, tax benefits. And then year two, yeah, you can totally just switch to year two. You can just have a property management company and you don't have to do material participation. You don't have to do that anymore. The only thing is that if you unfortunately have losses that year, you have a bad repair or bad leak or something bad happens, the losses you can't take as active anymore. So once you stop material participating in the property and you don't have the average stay of 7 days or less, it'll go back into passive losses and go back to the default. So like we said, default is always passive. But generally speaking, everyone's a smart person here. We underwrite the hell out of properties, assume the worst case. Year two is highly profitable because you don't have any more depreciation. You just have the straight line depreciation. Then, that's totally fine on that side. But yeah, when you're doing the short-term rental loophole, the five, let's just pretend we're back to 100%. I'm gonna I'm gonna manifest that they're gonna sign this into law. You took 100% of this already, then you're only really left with the 39-year property left, which is less the bones of the house. And then you'll just pick up, say one, like, what, 800, yeah, say 800 divided by 39 years. You'll just pick up this little amount. It's not a ton. So it'll help a little bit, but it's not going to be a ton. You're more likely than not going to be very positive, especially since it's an Airbnb. You're going to have a lot of rental income. That's why I say year two, year three, you really want to buy another piece of property to offset it. Otherwise, you're going to pay taxes. All right, great. All right, so Maggie, the cost seg only offsets passive income unless I qualified for reps that year. Correct. So almost. I'll dive into this. Yeah, this is actually a pretty important principle of like when to use the cost seg. So when to use the cost segregation study, there's three flavors of when to use the cost seg studies. The three flavors here is short-term rental loophole, Second flavor is rep status. And then there's actually the positive passive income. So I don't want you to think in definitives. It like all tax planning is they're just tools in the toolbox. You just need to know when to pull it out. Like you wouldn't screw in a screw with a hammer, right? You would just go pull out the drill. So you just pull out the tool at the right time. So STR loophole, you need it. Reps, you'll need it. But this one is a sleeper that people do not focus on as much is the positive passive income. So let's just say, for example, that you did STR loophole year two, and you're like, I mean, STR, it's still an STR, you're not doing a loophole, sorry. And you have a lot of positive income, but then you have a second property, let's just say it's a LTR. You can just go ahead and run a cost seg on this, and then this cost seg will pick up extra depreciation, light it on fire, and then you can reduce this income and wipe it out. So that's a good time to do it. Also, if you're like in different silent partner deals, say if you like invest in someone's restaurant, you're just a silent partner picking up a K1, that's another good time to offset it too. So that's when you want to use a cost seg. They are costly, so evaluate when you want to buy it, how many you want to use. There's a time for it at the right place. So great question there. And then Jay, I sold a property at a loss. I'm done. So if you sold a property at a loss, you would be able to take a loss against your taxes. So it's unfortunate that it's a loss. So, but hey, at least on the tax side, you get like a second place trophy, and you're able to write that off. And cool. Is that cap at 25%? Sam says, with my tax rate is less than 25, depreciation recapture. Yeah, so if your tax rate is less than 25%, so going back up here, this is a max of 25%. But let's just pretend that it's 20, you're in the 22% bracket that year. Recapture is only gonna be at 22. If you're at 12%, it's only gonna be at 12%. So recapture max is 25, and then it'll just go down to your normal rate on that side. So that's, depending on the year when you can do it. All right. And then, number, how does cost seg duration of long-term offset active? Oh, so it does not offset active STR. So let me draw this one out. So we got an LTR house here, right? Terrible drawings. And then you got an STR here. I'm going to say this is a year two. And you are, move myself down here. You are not doing the loophole this year. No loophole. Because you have a property manager, you're not doing anything. Is on year two, you're going to be in the green now because you took all the benefit in year one. So you don't have much depreciation left. So you have positive. I'm just going to say you're up, 12, 15 grand, right? Positive. Now you're like, oh crap, I don't want to pay taxes on 15K of rental income. So what you can do is this LTR that's just been sitting on the sidelines is now you can run a cost seg study on this, accelerate all the depreciation you never took because they're like, it's losing money. I don't need to take anymore. Now this thing, say it picks up in 30K of losses, this 30K will come and kill off this 15K, and then you'll carry forward negative 15K for next year. So let's just say once again, year three now, this STR is just producing well for you here. I don't know why my pencil went. Oh man, got conquered by technology tonight. All right. Oh, here it goes. All right, cool. So then say next year, year three, let's just say you had a 30K positive because you're just killing it in STR game. You can bring down this carryover from the prior year because you ran the cost seg from here, and then you'll pay less. You'll just pay taxes on 15K. So that's when you can use these. So let's just take another example. Let's say you have an LTR, and then let's just say you have a restaurant as a passive partner, and say the restaurant generated 12K of positive income for you, and then your LTR cost seg this again. Oh, geez, I can't spell cost seg. And then say this picked up negative. Oh, okay. Share feedback. All right. Negative 30. Let's see here. Negative 30K. once again, this 30K can be used to offset that 12. So there's just different ways to use cost seg studies and use real estate. So after a while, some of our clients, I just start telling them like, hey, start getting into passive businesses because one, they're never going to meet reps. Two, they don't want to do STR loophole. And I'm like, dude, we got a bank of losses. We need to do something with these. So let's just go into some businesses that are going to generate some cash flow, be a silent partner in a laundromat. I don't know, whatever floats your boat. I just use restaurant a lot because I was raised in my dad's restaurant and passionate about food. I love food. So that's why I use restaurants as that example. All right. And then at the high level, the best ways to offset active income taxes other than reps. Yeah, so we got about 5, 6 minutes left here. We'll just dive into some more advanced stuff. So I think we killed off the W-2 side pretty hard. So hopefully everyone's W-2. If not, we'll have session 2 months again. We talked about 1099 stuff. But yeah, if you're so other ways to offset, active income. Let's see here. Other than reps. Yeah, so active income, this is really why I'm a very big fan of just businesses in general. So businesses, you can take losses. I think this year it's around 270K loss up against your active income. If you're married, this doubles. So it's what's that around 540-ish or six? Yeah, 250. Let's see, it's like 640 here. 400. Yeah, 540. Jesus. Okay. All right. So 540K if you're married. So that's the max cap you can do in year one. The rest just gets rolled over into the next year. And these business losses, this is really where investing into active businesses where you're going to manage and run those can actually help a ton. So, let's just use the classic example of a laundromat. Laundromat, or I could actually just use it. Well, actually, I have a client that did this. So, laundromat, say you buy the business and it's for 250K. And then let's say you did 20% down. So, you did 50K into the business. Oops, 50K. So because it's a laundromat, and if you structure it right, aka buy the assets, don't buy goodwill. That's another issue I see when people buy businesses is they're buying goodwill, which is not good for depreciation. Is that this 250K, instead of you paid 50K, right? And you think you'd be able to write off 50K. What you could do next is actually you can write off the full 250K. And the full 250K can be offset against your W-2 income because this is an active business now. So that's kind of like the big thing there for you. So you could do this, and obviously you're making, say you're making 300K as W-2, this 250K loss because you're going to bonus depreciate a good chunk of it here. You could do that. So businesses is one great way to do it. There's some other like more sketchier ways that you can get into it. So, SDR loophole reps. There's other parts that, oil and gas. It's not sketchy. I just don't it's like a tier 3 investment for myself. Like if I were investing in stuff, I would go business real estate and then like alternatives. So oil and gas investments are great to do. The reason why is because they are passive but offset active income. So the main part is if you say you put 100K into a deal, and usually their minimums are about 50 to $100,000, is that this anything that's an intangible drilling cost, so anything to set up the oil well, so they call it IDCs, will offset your active income. Say that's 75%. So you take this 100, you have 75K, and it would reduce your W-2 income by this 75K. So oil and gas is one. Other ones that our clients tend to use are investment solar. So investment tax credits. So this is through commercial solar. Also, if you have your home and you want to support the environment, Mother Nature, you put solar on your home. But commercial solar, how it works is you get 30 to 40% of a tax credit. And then you also get depreciation because you're going to turn that into active losses on that side. So these deals, they're usually at least a minimum of 100K to get in. It is kind of sad though, like the rich always get richer. Like it's the name of the game. So it's just like, all right, how do we get to that running point? And then there's, other parts, there's leverage charitable donations. So anything in the charity space on this side, charity that can be, you know, Annie's college that you can donate towards and get some scholarships for the kids over there. You could also do donor advised funds. And then the gray area, say it's like conservation easements, right? So these are other areas that you could do. So those, I always joke around, say like, Pokemon cards. If you got a legendary Charizard, you donate that to a museum. That's why rich people buy art. So that's another example for you there. So those are bigger ways, more advanced and more aggressive strategies that you could definitely get into to save in taxes. And then, yeah, I'll take just a couple more questions on this side here, and maybe we can call it a wrap here then. Then we can continue on. Also, if anyone wants my chicken scratch, I can share this over to you. Just DM me on Instagram. We'll set up some automation to do this. The CPA dude is like our Instagram handle, and just DM me Sarah, and then I'll figure out the automation to send this to you. If not, I'll manually send it to you. So if you want all these chicken scratches, we can definitely do that too. And then let's see here. And let's see, STR loophole goes back to 100%. I have a lot of LTR. Can I do cost seg in the same year to offset a high income IPO year? So your LTRs, you would have to either one, convert those to STRs, or two, you could turn reps for the year and then make a grouping election to offset all of that. So that's one strategy that you could do. And then Alvin, opportunity zones. Yeah, opportunity zones, I'd say is zones. They're just the ugly duckly version of 1031 exchanges. And essentially, the cool part on opportunity zones is that it is real estate plus capital gains from stocks, though. That's the cool part about this one is that so if you had a lot of company stock and I don't know, say you work at Nvidia and you went to the moon and you're super rich, make some donations, of course, and you're just like, how do I get rid of this without getting murdered in taxes? You could put the money into an opportunity fund, and then that opportunity fund can then invest into opportunity zones. Lack of better words, opportunity zones is the hood, but it's not that hood in like anywhere in California. So that's going to be that portion for you there. So then that way you'll defer it. If you hold on to it long enough, they'll forgive 5 or 10% of the cap gain originally. So it's one way to do it. There's actually more advanced strategies from ozones I've seen is you actually do an opportunity zone, you put it in towards December, you let it fail purposely the following year, and you don't have to pay taxes until the following year. So that's another way to really kick the can down the road. It's a bit aggressive, don't get me wrong, but it's definitely out there. So taxes are that's kind of like it's only as you can get as imaginative as you want on that side. So opportunity bone adjusted. Yeah, so you just got to set up the LLC in the right way for the opportunity fund on that side. So this is an LLC at the end of the day. And then not oh nice, Mike. Mike, yeah, did not hood at all in San Bernardino. And then yeah, reps, just to cap it off, is this is the ultimate unicorn of man, I wonder if I can draw a unicorn. Yeah, it's probably not. Yeah. Smile. Okay, so anywho, is real estate professional status. We'll probably end on this last question here as real estate professional status. This is the unicorn. This is like the classic, like you're a doctor or software engineer, and then you are married to the stay-at-home person who manages the whole entire real estate portfolio. So this is 750 hours in the trades or businesses of real estate. That's hoop number one. Number two is over 50% of your time. So this is why usually you have to be married, is because a full-time job is 2,080 hours. I own a company and I don't even work, 4,000 hours myself. So I highly doubt that there's probably super hardworking people out there. The IRS is just not going to really buy it. Is over 50% of your time is dedicated in the trades or businesses of real estate. And then lastly is three is you have material participation, which is the seven prongs. Lack of like simple terms, you work a lot. You worked on your properties. Yeah. So that's going to be on that side. So the whole reason why you go through all these hoops for real estate professional status is because you can turn all your realtor or not realtors, all your real estate income that's defaulted as passive and offset your active income. That's why you always have like, you got the doctor over here, and then you got, the partner on this side over here. I'll make a little top hat, make this one here. And then all these income gets offset. So that's like the big part there. So yeah, we'll leave it at that. And then yeah, if you want to connect with me there, Mike, yeah, just hit me up on Instagram, the CPA dude. Easiest way to kind of like find things these days. My inbox is a mess, so IG's a little bit easier on that side. So but cool. Yeah, if anyone's got questions, yeah, just hit me up there. More than happy to answer some questions. Probably turn in some Q&A content, to be honest, there. And we'll have our session again in two
July 2nd.
months, a month, July.
So
Oh, right before the 4th. Yeah.
I know, like we love taxes so much, but you got to do it right before we go on holiday. But for you guys like that are in here, I know we talked about a lot of, different strategies and information. And so what we're going to do, we will be sending this recording out. If you already registered, I have your email. Don't worry, I'm too lazy to spam you guys with junk because I don't even waste time on my, reading emails. So I'm getting that to you guys. But I want you guys to also think, as you review the notes, which strategies you guys feel comfortable with and implementing, because this is all talk until you actually get this in place. And what that means is you guys need really good record keeping, tracking your hours and documentation. So if you guys, struggle with that and, getting your organizer, Tony has a really good organizer setup that he's happy to share with you guys, especially it's really useful for like the W-2 folks. And the those are dabbling in real estate for you just kind of tracking your things. But once you guys start trying to get, to do the short-term loophole and plus your reps, you guys really need to track your hours and document. And that's something you guys really want to work on logging and organizing yourself throughout the year, not waiting last minute and bullshitting things because you'll just stress yourself out. So if you guys have questions, need help, you guys want the organizer, please go ahead and reach out to Tony through, I guess, Instagram. Is that your preference? If they have they want the tracker from you?
Yeah, I'm slowly figuring out my automations there. So
And he's
yeah.
gonna get his VA to help you with that right now.
Oh yeah, yeah.
Get them
Uh-huh.
to
Yeah,
help
yeah.
you.
My content man, yeah.
Exactly. And then also we do these office hours like every other month, but just to let you guys know, Tony does have another service where he has office hours once a week. And he has updates like at least once a month on like, the new rules and stuff. So if you guys are interested in learning more about that, go ahead and reach out to Tony. There's just a lot of information to learn and organize. You want to keep yourself, tracked. But like Tony mentioned, our next session will be on July 2nd, and this one is going to be a really interesting one for us, actually. It's not something we've always often talk about. The topic is called lazy 1031 exchange, and then we look, and then also opportunity zone. So we talked a little bit about that today, but we'll go more in depth. But I'm really excited for lazy 1031 exchange because it's kind of like for those who want to get rid of your property, but you don't want to, you want the tax savings, but you don't want to buy another property or manage. So this is going to be pretty interesting to learn about. So without further ado, thank you guys all for your time. Check out, wait for your email maybe by Friday or Thursday or Friday. I will get this recording out to you guys. So thank you guys so much. I will catch you guys soon. Take care,
Thanks, guys.
take care. Bye, 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 bye. 안녕, 再见.